This video is going to look at 6 dividend growth stocks that are currently reporting earnings through the lens of our Fast Graphs fundamental analyzer software tool. The primary objective that this article was intended to illustrate was the reality that there are actually 2 performances when evaluating a publicly traded company or operating business. The first is the price performance, and here we plot that on our Fast Graphs by plotting the monthly closing stock prices depicted by the black line. But the second performance, which is actually the most important in our opinion, is the operating performance, and that's depicted by the orange earnings line here, which represents the fair value based on earnings of the company. So it shows the business results. And one of the advantages of Fast Graphs is when you can instantly look at a company and tell what type of operating performance it's been able to achieve over whatever period of time you're looking at. In Intel's case, we're looking at 6 years, and we see what I called in the article a quasi-cyclical company where earnings have fallen and risen ever so slightly, but generally earnings growth has averaged about 7.6% over this time frame. Intel currently pays a 3.1% dividend, and based on the fact that this orange line represents fair value, the stock is currently undervalued at this price. The light blue shaded area represents dividends paid out of earnings, which are the green area. In the case of Intel, it started out fairly valued but ended undervalued, so the earnings growth rate of just under 8% only translated into a 1.5% growth rate. But we do want to note that the dividend per share has increased every year on Intel, and Intel currently appears to be undervalued based on the consensus of leading analysts who are forecasting a 5-year 10% growth rate. We have the corridor of value here, which is represented by these 5 orange lines, and Intel is currently trading below the corridor of value, which would indicate that it was significantly undervalued at a PE ratio of only 10.5. A lot of tech stocks are currently in this same situation. But if Intel is capable of achieving this earnings growth rate, then by 2016, it could be achieving a $52+ share price based on the stock trading at a more normalized 15 times earnings going forward. Our second example looks at Abbott Labs, and as we pointed out in the article, we call this the paragon of consistency. As you can see, Abbott Labs has increased earnings every year, year after year, at approximately a 10.7% rate. For the first 3 years on this graph, the market had priced it above its earnings justified level, and the last 3 years, thanks to the recession, the market has priced it below its earnings justified level. But the operating results of this company have not faltered or changed. They've continued to grow. What we really have here is a change of attitude about the company. But we end up with we start out with some slight overvaluation. We end up with some slight undervaluation. So therefore, long-term performance of Abbott Labs turns out to be about 3.8% on just a capital appreciation, or what we call closing annualized rate of return basis. But we add in an increasing dividend, a dividend that's increased every year thanks to the consistent earnings growth, and shareholders would have earned 6.2% in Abbott, even though the market only did 2.6%. But the point we want to really make most emphatically here is that Abbott is currently undervalued, and during this time frame that we measured here, it was overvalued. Our third example looks at VF Corporation, and here we see a stock that the market has traditionally undervalued. But what you'll notice here is that the price started below its earnings justified valuation line, and the market has generally priced this stock below its earnings line, as depicted by the normal PE ratio here. Currently, the price is a little above the earnings line on a historical basis, and therefore this has one of the best performances of any of the 6 companies we've covered, because it starts out undervalued and ends up slightly overvalued, and therefore shareholders earned a 4.4% total compounded annual rate of return, add in dividends, and that increased up to 16.4%, once again against a total return of the S&P of only 2.8%. Currently, analysts expect VF Corporation to grow by 12% a year, and within this value corridor connotated by these orange lines, the stock is sitting on the one line above the fair value line, which means it's still a very fairly valued stock, but you do have to consider the fact that the market has typically undervalued this company. Next, we look at United Technologies, and here we have a company that the market has typically priced very consistent with its operating results, especially if we expand this out. If we expand this out to a 15-year graph, I want you to notice that price and earnings have correlated very closely. When the earnings of this company faltered in 2009, although they remained highly profitable, you can see that stock price during the Great Recession, became significantly undervalued relative to its historical norms, and then the market has recently brought it back up to what I would call the normal valuation that the market has historically applied to United Technologies. They did report earnings today. Earnings were up about 19%. I haven't studied the report yet. On a performance basis, based on the valuations we just looked at, this company has generated an 8.8% compounded closing annualized rate of return. Add dividends, that number expands to 10.3%. And I want to point out, we always assume that the dividends are being spent here, not reinvested, because we're trying to look at a pure performance rate. But again, you see a company who's increased their dividend every year during this time frame. The current consensus of analysts is that the company will grow at 12% a year, and therefore, on that basis, if those estimates were true, then the company is very, very fairly valued, just sitting one notch above its fair value dark orange earnings justified valuation line, but well within the corridor of value. Our next example is Stryker Corporation, and what's interesting about this picture is a company, you see here a company where the operating performance has remained very consistent, only a very slight flattening of growth rate here. Earnings actually continued to expand even in the Great Recession, but the market had normally put a premium valuation on this stock, but more recently have been pricing it more in line with its earnings justified value as we define it. But because of overvaluation in the beginning and only a more modest overvaluation at the end, we will discover that a 13% earnings growth rate translates into about a 5% compounded rate of return, and add in dividends and we get it just under 6%. But the important takeaway here is, notice that although dividends have increased every year, they started out in 2006 where they were just kind of still leaving their growth phase with only a 5% payout ratio. That's now expanded to 18%, but this company does offer one of the lowest yields at 1.2% of any stock we looked at, but it does have good growth potential and currently trades at a very attractive valuation relative to its earnings potential. Our final example looks at PepsiCo, and once again we see a company where we look at the earnings performance of the company, and we find that this company has been a very excellent operator. Its earnings growth has been very consistent at 8.6%. You can see that the market has applied a premium and actually priced this stock almost in line with the amount of dividends that it pays out of its earnings. But then once the recession came, and again, investor attitudes have changed, where they're generally more pessimistic, especially for some reason against these these large cap, high quality blue chip dividend-paying growth stocks. We find we currently can buy Pepsi at a 3% dividend yield, which we think is very attractive. The long-term record of this company, even with the massive valuation adjustment that I just depicted, still shows this company outperforming the market over this 6-year period. But again, we want you to notice that dividend growth has increased steadily. The dividend growth rate has remained, pretty consistent. There have been times when earnings were great and the dividend grew a little faster than it did during the recessionary times. But the company pays a good dividend. Currently, it's priced almost for perfection. The leading analysts expect about a 7.8% going forward. That's within reason of what they've historically been able to achieve. It may be just a little bit of pessimism applied to that consensus estimate, but the stock appears to be perfectly valued, offering a very attractive long-term rate of return going forward at these levels, especially for such a blue chip holding.